Hello, everyone. Welcome to the Endowus webinars with Amundi Asset Management. Today, we'll talk about the Flagship CPF Portfolios made better with Amundi low-cost fixed income. My name is Hugh Chung. I'm the Chief Investment Advisory Officer of Endowus. I'm joined today by Yulin, who is our investment lead, and Sunny, who's the head of ETF indexing and smart beta South Asia for Amundi. Yulin, you want to say a quick remark?
Sure. Yeah. Hi, everyone. I'm Yulin. I'm the investment lead, and I'm very happy to be here with all of you today to talk through the recommended portfolio changes.
Sunny?
Hey, hello, friends of Endowus. I'm Sunny, so I head up the ETF indexing and smart beta business for Amundi in Southeast Asia. Thank you for having me today.
Okay, great. With that, let's start the webinar. Okay, we will have to go through our usual disclaimers as usual. And you can always ask your questions on Slido. And I think we've already been getting some questions, but feel free to ask the Slidos during the webinar. So before we start, I wanted to make a quick introduction to Endowus as a platform. We're here to help everyone invest better, live easier today and better tomorrow. Next page. So we are one of the largest independent digital platforms with a lot of credits to our technology, backed by global and strategic investors, including Citi Ventures, EDBI, Lightspeed, UBS, and MUFG. Next page. So 2 weeks ago, we successfully completed our fundraising for $35 million of new capital into our fund. We were joined by new investors, Citi Ventures and MUFG Innovation Partners, along with 4 of the largest family offices in the region. And our existing investors, including UBS, EDBI, Lightspeed, Process, and Singtel, have increased their investments in the fundraise. As you know, since 2019 of October, when we first launched our first Singapore's first digital advisory for CPF, we've come a long way, and we currently manage $5 billion of group client assets, of which over 1 billion Sing dollars are in CPF and SRS. Next page. So as you can see on the slide, we work with some of the leading fund managers in the world, from Aberdeen, BlackRock, Amundi, of course, Schroders, UBS, everyone, PIMCO, as you see in the slide. Next page. So we have in our platform a combination of advised portfolios and build your own portfolios. And the advised portfolios would include your core portfolios that have a balanced mix of equities and fixed income, as well as satellite portfolios, income portfolios, and cash smart portfolios. CPF would be part of the core portfolio offering, where we curate the best-in-class funds that are available for CPF investors, and we charge a lower fee of 0.4% for our CPF investing. So with that introduction, I'd like to hand it over to Sunny for a brief introduction of Amundi.
Hey, thanks, Hugh. So we are very glad to be here. So for those who are new to Amundi, Amundi is the largest European asset manager and one of the top 10 managers globally. So together we manage over 2 trillion of assets. So our economy of scale allows us to manage ETF and index fund in a very cost-efficient manner. We have further boosted our economy of scale last year by acquiring Lexor ETF. After the acquisition, we are the largest European ETF issuer with more than 300 ETF and 200 billion of assets. In Singapore, we have an office of over 60 staff to service our clients locally. We have started offering Singapore recognized index fund exclusively with Endowus since last year. And this year, we have made further inroad by being the first asset manager to offer global equity and fixed income index fund with CPF. So our primary goal here is to provide better tools for Singapore investors. That sums up a quick introduction of Amundi. Back to you, Hugh and Yulin.
Yeah, so I guess a lot of you are here today to find out more about our flagship CPF portfolios and the latest upgrade that we have done with, Amundi's index fund being approved for CPF. So I will go through that quickly with you. But before that, just want to have a quick recap of our journey of making CPF investing better for every Singaporean, because this is really one of the big missions that underlies Endowus business. And to make CPF investing better for every Singaporean has been at the heart of this mission to improve retirement adequacy for Singaporeans. So as Hugh mentioned, we became the first digital advisor for CPF investments about 4 years ago. And I would say that was really a game changer because starting from then, actually investing on CPF is a lot easier and can be done online through a digital way. And since then, we have introduced the first low-cost index funds that track the US and global equity markets into CPF. So subsequently, we launched advised CPF flagship portfolios with these low-cost index funds. And in October 2020, we also launched Fund Smart, which includes CPF fund options. So actually, you can also DIY your own CPF portfolios. And all the funds that we have onboarded onto Fund Smart have gone through rigorous due diligence by our investment office. So in the past 2 years, we further lowered the cost of our CPF portfolios and expanded our CPF fund offerings on Fund Smart. 2023 has been a really exciting year for us. We have been working with Amundi to get their low-cost index funds into CPF eligible investment fund list. And it happened in 2 phases. So back in April 2023, the 2 stock index funds from Amundi Index MSCI World, which tracks the global developed market equities, and Amundi Prime USA, which is by far the cheapest index tracker for US equities market, got approved into CPF. So we immediately did a 3rd portfolio upgrade for our CPF flagship portfolio to include these 2 better fund options. And today we are introducing the 4th CPF portfolio upgrade to the fixed income component of the flagship CPF portfolio, following the approval of Amundi Index Global Agg 500 mil fund. So the new CPF flagship portfolios will have a lower investment cost. The new portfolio obviously will include, as you can see here, the Amundi Index Global Aggregate 500 mil fund. And it is the cheapest fixed income fund available for investments through the CPF investment scheme. Its fund level fee is just 10 basis points per year. And the new flagship portfolio, the fixed income component, will have a cost that is 17 basis points, or actually 41% lower compared to the previous version. So to look into what's inside the new CPF flagship 100% fixed income portfolio, the new portfolio will have the home buyers meaningfully reduced, and the geographical diversification of the portfolio would improve. The pie chart shows you a comparison in terms of the geographical allocation of the current and new flagship portfolios, and the new one has its Asian allocation reduced, while its US allocation is increased. Additionally, the new CPF flagship portfolio will also have higher credit quality, reducing the overall credit risk taken by the portfolio without much compromise on return. And the bar chart shows you the comparison of credit rating allocation between the new portfolio and the current portfolio. And the new portfolio have meaningfully less BBB rated credits and more AAA to single A rated credits. Finally, in terms of sectoral diversification, the portfolios remain sectorally diversified, and there are marginal changes. For example, you can see on the right, the new one has slightly more allocation to government bonds. And this is a reflection of the improvement in terms of its credit quality, as well as its geographical diversification. So of course, people would be caring about, how does the risk and return look like now? And I think with every upgrade, we really aim for improved long-term risk-adjusted return. And essentially now we have concluded an upgrade to both the fixed income and the equity components of our CPF flagship portfolio. So obviously today the focus is on the fixed income components. So I'll talk about fixed income component first, which is on the left-hand side. It plots the 10-year risk and return. The historical risk and return of the flagship CPF 100% fixed income portfolio. And you can see that the new one has a risk level that is closer to the benchmark, which is represented by the Bloomberg Global Aggregate Index. This means that over a full market cycle, it will be able to capture the market return better than the previous version. And obviously, equity is actually a very important part of a balanced portfolio for an investor. And the new 60-40, which is 60% in equities and 40% in fixed income portfolio, has historically shown a better risk-adjusted return than the previous version. And obviously, we know that historical return is not representative of the future return, but I think this gives you a good sense of how the risk and return would have moved. And we have been seeing some questions already on Slido in terms of the comparison between, I guess, projected return of our flagship CPF portfolios to the guaranteed return, which is 2.5% from CPF. And I have two points to make here. Firstly, it is important to think of your equity and fixed income ratio for your, I guess, long-term CPF portfolio allocation. The reason is because in the long term, a combination of equities and fixed income should be able to give you a return that is higher than your guaranteed 2.5%. But obviously, this comes with you being willing to take on some additional risk. And you should maybe, it is important for you to assess your risk tolerance, and our platform gives you a good advisory flow to help you assess how much risk you can really take by actually showing you the historical drawdowns, the worst situation that have happened historically, to give you a good sense of that. And the second point is on fixed income market, because people are saying actually looking at the historical return of a global fixed income index or the flagship portfolio, it's not that attractive compared to 2.5% guaranteed return. And it is true if you just look at where we are now. But I think the context to that is we are in the midst of a market cycle. And actually, fixed income market have just gone through its worst 2 years, starting from 2021 and 2022, in the past 4 or 5 decades. And that is the extent of the drawdown in the past 2 years. But with every market correction, the future looks brighter, because actually there has been a re-evaluation of bond price in the market as interest rate has moved up. So to give you a sense, the current yield to maturity of the CPF, just only the fixed income component, is 4% now on a forward-looking basis. And that is higher than the 2.5%, and that is higher than, I guess, the latest CPF print in Singapore, which is slightly below 4%. But it's something to have in mind when you are entering the fixed income market right now. And just to quickly go through how to accept the recommended portfolio changes. So you would receive an email later today or tomorrow, and that gives you a notification for the recommended portfolio change. So there are 2 ways to accept it. You can actually log in through the link on your email and click on the notification bell on the top right corner. And then you can view the portfolio change for the affected portfolios for you. And after that, our platform will take you through a comparison between the portfolios before you accept it. Or you can just go inside your affected goals. So if you log on the left-hand side, you can go to the goal. And then on the top right corner, you can click on manage goal, and you'll be able to see view recommended changes, and then go through the same comparison before you accept the changes. And maybe one thing to kind of highlight, I think probably many investors have not accepted. There are still some investors who have not accepted the recommended portfolio changes that we have sent out in April for your equities component. So if that is you, you can actually go inside and accept it now, and the cost will be lower and it will be more balanced and diversified. So that is a quick overview of what is going to happen to our flagship CPF portfolio, and we highly recommend you to take a look and consider the change. But as I mentioned, Amundi Index funds really are a very key component, a very key building block for our flagship CPF portfolios. And today we have Sunny with us, who knows the funds inside and out. So I will give the time to Sunny now for him to take us through, what's special about the Amundi Index funds.
Hey, thanks, Yulin. So to recap, we currently have 4 index funds recognized in Singapore for retail investor, as you see on the screen. So which include our MSCI World Index Fund, Prime US Index Fund, Global Aggregate Bond Index Fund, and our MSCI Emerging Market Index Fund. So for each of them, we offer both USD and Singapore trading counters. Out of the 4 index funds, MSCI World Index Fund, Prime US Index Fund, and lately the Global Aggregate Bond Index Fund are CPF approved. So staying true to our commitment to cost efficiency, all of these index funds are very cost efficient, with management fee anywhere from 0.05% to 0.2% per year. And as Yulin mentioned, Global Aggregate Bond is only 0.1%. So if you wonder how do we keep our costs down so low, so you can have a look at the next slide. There are 2 key, and then the next one, sorry, moving to the next one. So so basically there are 2 key elements here. Firstly is our economy of scale. Being the largest European asset manager, we have traded more than $1 trillion of equities and bonds last year and every year in the last couple of years. So this massive amount of volume has granted us a preferential status with brokers globally, what they call a platinum client, which these platinum client status effectively keeping our trading costs very, very low. Furthermore, our 2 trillion economy of scale significantly reduce our internal expense, which directly translated to more cost saving for our clients. And for the second pillar is on the next slide. Behind our cost efficiency is technology. So specifically, our state-of-the-art index replication system, as you see on screen, our Auto system. So thanks to this Auto system, majority of the index replication process are automated, which ensure both accuracy and efficiency. And this very advanced system allows us, our portfolio manager, to oversee more than 20 portfolios for each of them. For example, basically all these index replication are done with a fingertip, so they can click on optimization and send the trade orders. So it's very efficient and effective. So this use of technology, which enable us to deliver very stable and consistent performance while maintaining a very lean operation structure, leading to very low cost expense here. And if we move to the next slide. So for the index fund we have launched this time, it tracks the Bloomberg Global Aggregate Bond Index. For those who are not familiar with this index, Bloomberg Global Aggregate Bond Index is like S&P 500 index. It's the most widely tracked bond indices globally. According to Bloomberg, there are more than trillions of assets tracking this index, from asset owner to mutual funds, etc. So this index was launched in 1990 with over 30 years of track record. It includes more than 16,000 bonds globally from over 2,000 issuers across 73 countries. About 70% of the index, as Yulin mentioned earlier, are government bonds like US Treasury, which is very high quality and stable. It also comes with about 22% investment grade corporate bond, and also about 10% of mortgage-backed securities. So in summary, it offers investors a very comprehensively diversified bond portfolio. If we move to the next slide, so one benefit of these index funds is that historically, global aggregate bond index is out of reach for retail investor. And you may ask why? Because to procure the entire portfolio of global aggregate bond index, you might need more than 200 million US dollar. However, the emergence of the index fund have literally liberalized the landscape. Today, for as little as about $100, retail investor can gain exposure to this very diversified global bond exposure with over 16,000 bonds very easily. And if we move to the next slide, it shows you the characteristic of this bond index fund. So currently the bond index fund has about 2.5 billion in assets, so very sizable. As you can see from the line chart on the left-hand corner, the Amundi Global Aggregate Bond Index Fund tracks the benchmark very, very closely. The two lines almost overlap with each other. So the portfolio currently has a credit rating, average credit rating about A, and also provide a yield to maturity at about 4.3%. So with interest rate and inflation peaking, we are seeing more and more institutional investors getting into bond market. And Global Aggregate Bond Index Fund is one of the most popular choice among all. For CPF investor, we have created a Singapore dollar hedge version for you, so you do not have to worry about the currency risk in this exposure. And moving to the next slide. So apart from this Global Aggregate Bond Index Fund, I just want to recap that we also have two other CPF approved index fund, which provide very diversified exposure to global equity and to US market. Starting with MSCI World here, like Global Agg, MSCI World Index is the most commonly referred equity benchmark in the world. It consists of 23 developed markets and over 1,500 securities. So our index fund has over 5.9 billion of assets and is available for as little as 0.1% per year. So investors can own a very diversified portfolio of global market equities like Apple, Nvidia, Meta, Alphabet within one trade. And moving to the last slide I have. So for those who are more keen in the US market, we also have a very cost efficient US index fund at the cost of only 0.05% per year. So the index fund tracks selective US large and mid cap index, which is very highly correlated with S&P 500 index. So that sums up to my session today. But once again, we are very proud to offer this extremely cost-efficient index fund in CPF scheme through the Endowus platform. We hope it can enable investors to construct a better retirement portfolio. So back to you again, Hugh and Yulin. Thank you.
Thank you, Sunny. Thank you for the very helpful and detailed explanation. I just wanted to highlight that, it is really a great opportunity for investors to have this type of cheap, well-balanced, replicated portfolios available for CPF. So maybe over the next page, Yulin. Going back to that question of, how do we compare a 2.5% guaranteed return investment versus investing in a balanced portfolio of equities and fixed income, we think that the answer really lies in inflation, right? So in July of 2023, Singapore's core inflation rose by 3.8%. So all else equal, if you have an investment that only gives you 2.5%, your real purchasing power will actually go down, right? So over the long cycle, global equities have given you 7% returns on an annual basis over a very long cycle. And a balanced portfolio, as Yulin explained before, a 60-40, for example, will give you something in the range of 6%. So it's well north of 2.5% return, fixed returns. Now, I know the subject of today is really just talking about fixed income. But as Yulin explained before, even for fixed income, we're at the point of the worst 2 to 3 year period of fixed income in returns. So if you look backwards over a 10-year period, it looks very bad. But on a forward-looking basis, even on a fixed income standalone, you should easily be able to generate returns higher than a risk-free rate of 2.5%. So I think there are really two questions for today. One is the immediate question of clients that are in the existing CPF fixed income portfolio to actually go through a recommended change which is a very easy proposition because you're automatically getting 40% cheaper rates or costs on top of getting a more diversified exposure. So I think that decision is really, really easy. But for investors that are not in the CPF portfolios, if you think about the comparison between the 2.5% guaranteed return, and a balanced portfolio, I think even that over a cycle, it will be very apparent, adjusting for inflation, that you need to be in a diversified portfolio. So today we only talk about fixed income, but we really need to look at the whole picture of both equities and fixed income. And for those of you who have not accepted the recommended change for equities, we encourage you to do that as well along the session. And for those of you who are not invested in your CPF in a balanced portfolio, we recommend using that because we really think that with the addition of Amundi's low-cost solutions, the proposition looks very, very interesting. So with that, maybe I'll turn to the next page. Yeah, again, I think this is, I think we can probably skip this. So as you can see, CPF is a significant part of the average Singapore household's wealth. It's also the fastest growing, asset base. So it's very, very important that we care about the wealth accumulation of the CPF accounts. And while a 17 basis point reduction in cost may not look like a lot, over time it accumulates and compounds into something much larger. And again, the difference between a 2.5% fixed return versus a volatile but over time returning 6% type of product, again on a compounded basis, will give you a very different result over a 5-10 year plus horizon. So can't stress enough how important that is. Next page. Yeah, so with that, this concludes our session on the CPF portfolios for fixed income with Amundi. We want to take some questions on Slido, so maybe over to you, Yulin.
Yeah, sure. And I'll just keep this on so that you can, scan a QR code in case you would like to schedule a meeting with our advisors from our client team. I think a lot of the questions have been answered because I think there has been questions on projected return and what makes sense for CPF investments. I will just address a few questions first. That's not really related to the projected return, but there is one question on how much exposure to China real estate and municipals in both portfolios. I will say it's very, very small because both portfolios, I assume it's equities and fixed income, they are constructed to be very globally diversified. And just to take the example of the fixed income portfolio, the benchmark is Bloomberg Global Agg Index. So the portfolio is constructed to kind of have relatively low tracking error to Bloomberg Global Agg. And Global Agg only has China government bonds and policy bank bonds. So there is the corporate names will not be included in a benchmark. And in our own portfolios, there could be very, very small exposure, for example, through the United Fund, which is focused on Asia, but it doesn't take it doesn't take a lot of credit risk at the current moment in that fund. So I know that people are worried about what's going on in China, and actually we are working very hard at the background to try to consolidate views from different fund managers and give people a perspective on what's happening there, and look out for that space. It'll come out soon. But I think no need to worry too much about exposure in this very globally diversified portfolio. And that's part of the reason why we always recommend people to use the core like flagship portfolio as their main position, so that any regional risk will not be overblown in their personal, investments. Anything to add, Hugh, on this?
No, I think it reinforces this current recommended change because, like Yulin suggested before, with the addition of the Amundi product into the CPF for fixed income, it actually diversifies our region away from being focused on Asia and much more diversified globally. So it really de-risks that. But as Yulin pointed out, the most important thing in a diversified portfolio is that you can sleep at night without worrying about certain regions affecting your overall returns, right? So the whole point of having a balanced portfolio is that you don't have to do anything about it and it accumulates wealth over time.
Yeah, exactly. And just to clarify on the cost, because someone's asking whether the change will increase the cost, and the answer is no, it will actually decrease the cost. And cost is a very important part of an investment return. So this will actually decrease the cost of the fixed income component by 17 basis points, which is very, very meaningful. So now the fund level cost for the fixed income component is only 24 basis points, which is very low. There is a question, maybe I'll throw this back to you, Hugh, which is even the 4% yield to maturity on fixed income portfolio look a bit low compared to a guaranteed 2.5% return for CPF?
Yes, I think that's a great question. I think I would answer that in two ways. One is, if you look at any investment, it always follows a spectrum of risk and return. So risk is just basically the other side of return. So there's a saying in finance where you say there's no free lunch. Only free lunch is diversification. So you get what you ask for, so to speak. So if you are opting for a 2.5% guaranteed return, I mean, that's what you're opting for, right? So the higher the risk spectrum, the higher the return. So from that perspective, the 4% yield to maturity is a slightly higher risk proposition that offers you a slightly higher return, right? So that's one thing. So you're right. I mean, if you don't think the additional 150 basis points is good enough, the answer may be you may need to take more risk. So that's the first part of the answer. The second part of the answer is that fixed income doesn't just play a role by itself. It actually helps lower the correlation of a balanced portfolio, which includes equities, which is what we're actually advising for. So the fixed income portion that we're talking about is actually also part of a balanced portfolio, which helps with the equity volatility that you have. So it actually helps you buy equity. And if you have that equities exposure, again, that combined balanced portfolio will give you something like 6% over the cycle, right? So then the 6 compares a lot more favorably to 2.5%, right? So what I wanted to explain here is that everything is in part of a risk and return spectrum. And perhaps, as you say, if I'm comparing a 100% fixed income portfolio with a guaranteed 2.5%, you may think, oh, it's not worth my time. I'm okay to not take the 1.5% extra return, but it's more nuanced than that. And then even the 1.5% is a much bigger number once you compound it for a long period of time. One last thing I want to say is that because fixed income over a longer period of time, looks probably at the high end of its yield. What happens is you potentially can also get capital gain from your fixed income investment as well, on top of the 4% yield to maturity. So that's one part of something that you can think of as well. But the more important part is what I've explained. It's part of a risk spectrum, and fixed income is also part of generally a balanced portfolio of equities that helps you buy equities into your portfolio, and that's why it's important as well. So I hope that answers some of that question.
Yeah, definitely. And actually on the risk and return spectrum, just to quickly address this question, which is, someone's comparing Amundi MSCI World Index return to the Global Agg 500 fund. One has positive return, one has had negative return. But I guess, as Hugh have alluded to, the first fund, MSCI World, is an equities fund. So it's kind of on your most aggressive risk spectrum, whereas the Global Agg 500 fund is actually your most conservative fund that's completely fixed income. And they're going through different cycles, obviously, but in the long term, the aggressive one will give you higher return because you take higher risk. And the conservative one will give you lower return because you take lower risk. So that's the difference. Let me just go through some other questions.
While you're thinking, Yulin, I just want to add to that point. It's always very easy to take one snapshot and say, why is this, why is that? But I think it's because right now you'll say, hey, the higher risk one, MSCI World Equities, is positive, the slightly lower risk Global Agg is negative. What does that mean? But it's difficult because if you take currently snapshot, then that's what it looks like. But if you, for example, took that exact snapshot during the financial crisis or during COVID, different periods will look very, very different. So we always have to think of it through the cycle for a long period of time when you talk about risk and return.
Yeah, and I think it's especially relevant for CPF money because you can't take out until you're 55 or 65 years old. So you have a very long time period to think about how to allocate your CPF investments. And I think this is the last question we have unless people ask more questions. It's on inflation. So someone asks, latching on to the argument of CPF OA not keeping up with inflation, appreciate if you could discuss how your solutions take care of inflation. Thank you.
Yeah, maybe I'll take a stab at that and Yulin, you can add. Again, I think inflation is something that may look like it's moving a lot near term, but over a long period of time, it actually tends to be at a certain level. So if you look at the US, for example, the Fed is actually focusing on keeping inflations at around 2%. So if you look at a 10-year what we call inflation expectation or inflation break-even, which is the difference between the nominal 10-year treasury and the real 10-year treasury, it tends to be quite stable at around 2 to 2.5%, right? So the inflation part of it on a long period of basis, you can kind of think of it at around 2 to 2.5%. Now, with that in mind, if you have a guaranteed 2.5% product, again on an inflation adjusted basis, on a real basis, your purchasing power is pretty much staying the same, right? So the idea is to have the real wealth accumulate over time. Now, comparing to our solution, again, with a 60-40 balanced portfolio, for example, if that is able to give you over a long period something like 6% and inflation is 2.5%, then you're accumulating that 3.5% over time, right? So there will be years like last year when both equities and fixed income are down, in which unfortunately, your net worth will actually go down. But over time, you will continue to accumulate that 3.5%, which over a longer period will give you wealth above the inflation that hurt your kind of real purchasing power, right? So it is really about the long game. It's really about having the right asset allocation. So you'll be in the assets that will be able to beat inflation. And one of that biggest asset really is equities, because equities is a reflection of real earnings. And so what I mean by real earnings, I mean real life earnings, but it's really nominal earnings, right? It's nominal revenues, if you look at a company, the revenue that generates, it's actually nominal. It includes inflation and earnings as well. And the stock market is just a reflection of that. So if you own equities for a long period of time, you're actually getting compensated for inflation, right? So again, the whole idea of having a balanced portfolio over a long period is because over time, it's proven to be one of the best ways to beat inflation, right? So that's really the comparison between something that's largely the same, adjusting for inflation, versus something that over a long period will beat inflation for you.
Very well said, Hugh. I think that's it. We have addressed most of the questions, and if you have any further questions on investing, on CPF, on our product offerings, feel free to write into our CX advisors. It's cx@endowus.com, or you can schedule a call with them as well. With that, we will conclude today's presentation and webinar, and we look forward to seeing you again on our webinars.
Thank you, everyone.
Thank you.
Thank you, Sunny, for joining.